Most traders lose money because they never learned a single number. That number is 4, not 4 trades, not 4%, not some mystical indicator or secret pattern that YouTube gurus sell in expensive courses. The ratio of what you're willing to lose versus what you expect to win. 1 to 4, risk 1 unit, expect 4 back. This isn't hope disguised as strategy. This isn't motivation or positive thinking or manifestation. This is math. Pure mathematical principle. This is math that compounds into accounts that survive markets. This is math that separates traders who build generational wealth from traders who donate their life savings to the market and never understand why. The number 4 is the hinge. Everything rotates around it. Understanding this single ratio is the difference between financial freedom and financial ruin. Airs the brutal truth that most trading education hides because it's too simple to sell as a course. 90% of retail traders operate in complete reverse. They risk $500 to make $200. They've inverted the equation. They're playing a game designed to fail mathematically, and they don't even know it. They think they're traders. They think they're analyzing price action and making intelligent decisions. They're actually playing a rigged game. The house always wins when you risk more than you expect to gain. Not because they're unlucky, not because the market is rigged against retail, not because brokers are stealing from them, because the math is against them. Simple math, the kind of math that works the same in every market, every time frame, every asset class, every decade. The ratio determines the outcome before the trade even executes. They're doomed from the entry because the math is doom. Professionals know something radically different. They know that the ratio of risk to reward is the hinge on which every fortune turns. Not luck, not market timing, not even accuracy. The ratio. This single concept has funded mansions. It's generated retirement accounts. It's transformed ordinary people into traders who never check their account balance in panic, because the math is already handling the outcome. When you understand the ratio, you stop being afraid. When you understand the ratio, you stop being emotional. When you understand the ratio, you stop gambling. You start executing mathematics. Think about it this way to make it concrete and real. A trader named Marcus entered the market with $25,000 in capital. He had good instincts. His friends said he was smart. He could spot setups better than most. He had a natural ability to read price action and anticipate reversals. He wasn't stupid. He wasn't lazy. He had talent. But his entries were emotional. His exits were emotional. His position sizing was whatever felt bold that morning. He'd risk $2,000 to chase a $500 gain. He'd tell himself, if I'm right 60% of the time, I'll print money. Mathematically, that's actually true if you could maintain 60% accuracy. Psychologically, he was doomed. The ratio was catastrophic. After 6 months, his account bled from $25,000 to $8,000. He lost 68% of his capital. His instincts were still good. His ability to read setups was still there. His ratio was still catastrophic. He was trading backwards. He quit. He told people the market was rigged. It wasn't rigged against him. It was rigged by him. He did it to himself. Then, years later, Marcus learned the 1-4 ratio. Same Marcus. Same instincts. Same ability to spot setups. Same markets. Same volatility. Same chaos and noise. But now he risked $500 to target $2,000. He changed nothing except the equation. He didn't get smarter. He didn't learn new indicators. He didn't develop magical price-reading abilities. He just changed the ratio. He inverted it from backwards to forwards. 18 months in, his account hit $120,000. He turned $25,000 into $120,000 using the identical skill set that previously bled him to $8,000. The only variable that changed was the ratio. The math saved him. Not inspiration, not motivation, not a new strategy or a better indicator or a secret pattern. The ratio. This is the story nobody tells you, because there's no course to sell around it. There's no complexity to monetize. There's no mystery. Just math. Just discipline. Just the willingness to say no to 90% of the trades you see. This is where amateurs and professionals fork into completely different universes. The amateur sees a trade. They see price action moving. They see confirmation. They see the setup forming. Then they ask the wrong question, will this go up? That's the entire framework. That's the only question they're asking. The professional sees the exact same price action, the exact same setup, the exact same confirmation. and they ask an entirely different question. Is the ratio worth my capital? One question makes you money, the other makes you broke. One is about prediction, one is about probability, one is about hope, one is about math. These two questions might sound similar on the surface. They're fundamentally different. They lead to opposite outcomes. The amateur who asks, will this go up, is betting on accuracy. They need 70% accuracy to survive a 1-2 ratio. That's a high bar. That's hard to maintain. The professional who asks, is the ratio worth my capital, can survive at 50% accuracy with a 1-4 ratio. Same skill, different framework, different results, different outcomes. Here's exactly what we're going to decode in the next 10 minutes, and this is where the real education begins. First, you'll learn how to identify setups where the ratio actually favors you. Not theoretical setups. Not setups that could work. Genuine setups with mathematical advantage where the probability is already on your side before you click buy. Second, you'll learn how to size positions so that one ratio compounds into another, so that a single winning trade doesn't blow up your account through overconfidence, so that a single losing trade doesn't destroy your psychology because you size too big. Third, you'll understand the hidden psychological advantage that traders who use 1-4 possess over everyone else in the market. The advantage isn't luck. It's not insider information. It's not some secret pattern. It's leverage disguised as discipline. It's the calm that comes from knowing the math works, whether you're right or wrong on any single individual trade. That's power. But first, and this is critical to understand before we move forward, you need to see why even smart traders miss this entirely. You need to understand the difference between what amateurs call risk and what professionals actually mean when they use that word. Because risk isn't what you think it is. Risk isn't your position size. Risk isn't how much notional money you put into the trade. Risk isn't your account size. Risk is something much more specific. Risk is something much more dangerous. And most importantly, risk is something much more fixable. That's where we go next. That's the foundation everything else is built on. An amateur trader says, I'm risking $1,000 on this trade. What they mean is they opened a position worth $1,000. That's not risk. That's exposure. That's the notional value of the position. Risk is something far more precise and far more powerful. Risk is how much you're willing to lose before you exit. That gap, the distance between exposure and actual predetermined risk, is where fortunes are built or destroyed. Most traders have never even noticed this distinction exists. They use the words interchangeably. They think position size and risk are the same thing. They're not. Understanding the difference is the pivot point between accounts that survive and accounts that evaporate. A professional trader says something fundamentally different. They say, I'm risking $250 with a target of $1,000. Notice the precision. They've done the math first, before they entered the market, before they clicked the buy button, before emotions could cloud the decision. They know their stop-loss price down to the penny. They know their profit target price down to the penny. They've calculated the ratio. They've confirmed the setup passes their checklist. They entered only after the math was clean and the probability was mathematically on their side. The professional is trading math. The amateur is trading emotion. That's the only difference. But that difference compounds into millions or zero. Let's ground this distinction in real tape, real money, and real consequences that show exactly why this matters. A trader named Elena watched a particular stock consolidating between $48 and $52. The range was tight. The volume was climbing steadily. The pattern looked textbook bullish. Everything in her technical analysis screamed, buy this. She felt the pull. She saw the setup. She didn't want to miss the move. So she bought 200 shares at $50. But here's what Elena didn't do. She didn't place a stop loss. She didn't calculate her risk. She didn't define an exit. She simply thought to herself, if it goes to $75, I'm out with a nice $5,000 profit. That was her only plan. A hope, a target, no math protecting her downside. The stock never went to $75. The very next day it dropped to $45. The next week it fell to $35. Elena panic-held, hoping for a bounce. She didn't get one. The stock kept falling. After 3 weeks, she finally sold at $25 per share. Her loss was $5,000. She had bought 200 shares at $50. She sold them at $25. That's a $25 loss per share. 200 shares times $25 equals $5,000 lost. She thought she was risking $5,000 in potential profit. The truth was darker. She actually risked everything in her account because she had no predetermined exit. She had no stop loss. She had no protocol. She had only hope, and hope doesn't survive in markets. Now imagine Elena made the exact same trade but did it differently. Sees the same consolidation. She sees the same bullish setup. She buys 200 shares at $50. But before the buy order executes, she does something critical. She places a hard stop loss order at $48. This is non-negotiable. This is the line she will not cross. Her risk is now calculated and predetermined and written in stone. $2 per share times 200 shares equals $400. That is the maximum amount of money she will lose on this trade. Period. If the price touches $48, she is automatically out. No emotions, no decisions, no second guessing, no hoping it bounces back. Just the math executing the protocol. Now, if the trade works as planned, she targets $58 per share. $8 per share times 200 shares equals $1,600. That's her profit target, her reward, the upside potential. So her math looks like this. She's risking $400 to make $1,600. That's a 1-4 ratio. Clean, mathematical, professional. Before she ever entered the trade, the equation was decided. The outcome was already set up mathematically to favor her. She's not betting on luck. She's not praying. She's executing a calculated protocol that works over 50 trades, not on any single trade. The psychological difference between these two versions of Elena's trade is enormous. The amateur version, no stop, no plan, feels free initially. Elena feels like she has unlimited potential, no restrictions. She can ride it all the way to $75 if it works. But that freedom is an illusion. It's actually maximum danger. When the stock drops, she feels the pain of being down $400, then $800, then $1,500. The pain becomes unbearable. She panic sells at $25. She loses everything. The professional version, hard stop calculated ratio, feels restrictive initially. Elena places a stop at $48 and thinks, I'm limiting myself. But the opposite is true. Once she knows she's only risking $400 on this trade, she can breathe. She can watch the tape. She can wait for confirmation. She can see the stock drop to $45 and know exactly what it means. Her stop is getting hit. The trade is wrong. She'll take the $400 loss and move on. There's no emotional turmoil because the loss was pre-decided. It was already accepted in the math. She's not gambling. She's executing a calculated protocol. She's not hoping. She's trading. This is the psychological distance between accounts that compound and accounts that implode. The amateur feels every trade is a referendum on her intelligence. She's right or wrong. She's good or bad. She's a winner or a loser. The professional feels every trade as a data point in a statistical system. She's either executing protocol or she's not. She's either following the ratio or she's not. The emotion is removed from the equation because the equation is mathematical, not personal. Here's the counterintuitive move that separates professionals from everyone else in the market. Defining your risk before you enter is the most liberating decision you'll ever make in trading. It sounds restrictive. It feels like you're boxing yourself in. It feels like you're limiting your potential. The opposite is true, complete opposite. Once you've pre-decided your risk, you've actually freed yourself. Freedom isn't the absence of rules. Freedom is the clarity that comes from having rules. Once you know you're only risking $400 on this trade, you can breathe. You can watch the price action. You can wait for confirmation. You can think clearly. You're not gambling with blind hope. You're executing a calculated protocol that has a mathematical edge. The pros know this principle in their bones. They've lived it through hundreds of trades. That's why they have losing trades that don't feel like losses. They're following the ratio. They're trusting the math. They're executing the system they built. They know that if this trade is wrong, a $400 loss on a 1-4 setup is the cost of doing business. It's expected. It's factored into the math. Over 50 trades at this ratio, that $400 loss becomes part of a wealth-building machine. Some trades win. Some trades lose. The ratio makes sure that over time, the wins are bigger than the losses. The math handles the outcome. This is professional thinking distilled to its essence. Define your risk before you enter. Trust the ratio. Execute the protocol. Let the math compound. Don't feel the trades. Don't predict the direction. Don't hope for bounces. Define the risk. Place the stop. Enter with conviction. Exit at the target or the stop. Move to the next setup. Over time, the ratio builds wealth. That's not theory. That's the mechanics of how professional traders survive and amateurs go broke. Now that you understand the difference between exposure and actual risk, now that you know why professionals pre-decide their losses, you're ready to learn the exact structure that guarantees you're entering setups where a 1-4 ratio actually exists, because not every trade offers genuine mathematical advantage. And that's what separates traders who win sporadically from traders who compound consistently. Not every setup offers a legitimate 1-4 ratio. That's why amateurs lose money so consistently. They're forcing ratios where they don't exist. They see a minor bounce and convince. Selves, it's a high probability setup. They enter. The bounce reverses. They lose. They feel the sting. They rationalize it as bad luck. Then they force another trade. Same mistake repeated. This cycle continues until their account is empty, and they blame the market instead of their process. A professional operates with completely different logic. They wait. They have a checklist. They have standards. They have discipline. And that checklist starts with one foundational principle: price structure. Structure is everything. Structure is what separates signal from noise. Structure is what separates professional trades from amateur gambles. Here's the rule that divides selective traders from desperate traders, profitable traders from broken traders. A legitimate 1-4 setup has two confirming pivots. Not one. Two. A pivot is a precise point in price where three things happen simultaneously. First, price stopped falling or rising. Second, it reversed direction with conviction. Third, it showed genuine strength moving in the opposite direction. An amateur sees one reversal and enters immediately. They don't want to miss the move. They're afraid of being wrong. They feel the pull of FOMO, fear of missing out. A professional sees the first reversal, watches it carefully, waits patiently for the second reversal to confirm, then enters with absolute conviction. The professional doesn't fear missing trades. The professional fears taking trades that don't have mathematical edge. Let's ground this in a concrete example that will anchor this principle forever in your trading mind. Imagine a stock that drops from $80 per share down to $70 per share. That's the first pivot low. The market has found a level where buyers stepped in. Price stopped falling. Now it bounces. It recovers to $75. It's recovering well. It looks bullish. But here's where amateurs and professionals separate. An amateur watches this bounce and thinks, this is it. This is my setup. If I don't buy here, I'll miss the move. They enter on that first bounce. They're betting that $75 is a new floor, and the stock will keep climbing. They place a stop maybe at $73 or $72. They target somewhere north of $80. They feel smart. They feel like they spotted it early, but a professional doesn't enter yet. They know one bounce can be a fake out. One reversal can be a bull trap. They've seen this movie before. The stock bounces to $75. Then it drops again. It falls to $71. Now there's a second pivot low at $71, which is higher than the first pivot low at $70. The market is saying something clear. I tried to go lower. I couldn't. I found support at $70. I tried again. I couldn't break below that support. I bounced back to $71. This level is real. That's double bottom structure in miniature. That's confirmation. That's signal, not noise. That's when the professional enters with conviction. Now the professional executes the math precisely. They place a stop loss 2% below the second pivot. The second pivot is at $71. 2% below 71 is $69.58. That's their stop. They target a move back to $85 or higher, back to the old resistance level before the decline. So their risk is the distance from entry, approximately $75, down to their stop at $69.58. That's $5.42 per share of risk. But they don't enter with large size. They only risk 100 shares. 100 shares times $5.42 equals $542 of total risk on the trade. Their potential is the distance from entry at $75 up to their target at $85. That's $10 per share. 100 shares times $10 equals $1,000 of total reward on the trade. So their math is approximately 1.84, better than 1.4, actually closer to 1.2. But the point is clean. They've entered a setup with genuine mathematical edge. The risk to reward is favorable before they ever see licked by. Why does the two-pivot rule matter this much? Why is one pivot insufficient? One pivot can be pure noise. It's random. It's market chop. It's a fake-out waiting to happen. You'll see the bounce. You'll enter. The bounce will reverse. You'll lose. Two pivots mean the market is showing genuine structure. Two pivots mean support is real, not imaginary. Two pivots mean the market tested a level twice and found it solid both times. That's conviction. That's structure. That's signal. Professionals read structure like a language. They understand what price is saying when it bounces twice at the same level. Amateurs read hope. They see a bounce and imagine a rally. They trade sentiment. They trade FOMO. Professionals trade structure. Structure doesn't lie. Hope always does. This is where patience enters the equation as a practical trading tool, not just a personality trait or some philosophical concept. Patience is an edge. An amateur watches a stock drop sharply. He sees the first bounce and buys it immediately. He wants to catch the bottom. He wants to be early. He thinks early means smart. He buys on that first reversal. A professional watches the same stock drop. He sees the same first bounce. But he doesn't buy it. He waits. He watches. He counts the bounces. He waits for the second reversal to trigger entry. This waiting is not laziness. This is not being passive or timid. This is positioning yourself to be paid for clarity. This is what separates a 40% win rate from a 65% win rate. Not better entries, not better exits. Better selectivity. The professionals aren't smarter, they're more selective. They're willing to miss trades to focus on high-quality setups. Here's the nested clue for chapters that come later. The two-pivot rule only works if you're willing to miss some trades. You will watch a stock. You'll see that first pivot. You'll feel the pull. Your body will want to buy. Your FOMO will scream at you. Your brain will say, if you don't buy now, you'll miss the move. And you'll do nothing. You'll wait. You'll watch. You'll let that first bounce pass. That discipline is what forces you into high-ratio setups. That discipline is what separates the 5% who survive from the 95% who donate their accounts. Missing trades is not a loss. Missing trades is a filter. Missing trades is the cost of having winning trades. Every trade you skip is an account you save. Think about it mathematically. If you could take every setup you see, your win rate might be 45%. You'd lose money. But if you could be selective and only take setups with two-pivot confirmation and genuine 1-4+ ratios, your win rate might drop to 55%. But your ratio goes up to 1-4 or 1-5. Your average win is now much bigger than your average loss. Over 50 trades, that selectivity generates wealth. Over 100 trades, that selectivity generates serious wealth. The amateurs don't understand this. They think more trades equals more money. The professionals know better. Fewer, better trades equals more money. The two-pivot rule becomes a filter that ensures you're only risking capital on setups with mathematical legitimacy. It's not perfect. No system is. But it's filtering out 70% of the noise and keeping 30% of the signal. The setups that pass the two-pivot test have structure. They have confirmation. They have the mathematical probability on your side before you enter. That's the difference between trading and gambling. That's the difference between accounts that compound and accounts that evaporate. That's the difference between the 5% who survive and everyone else. Now that you understand how to identify setups where 1-4 actually exists, where the math is legitimate, you're ready to learn the trap that destroys most traders even when they get the setup RI. Because getting in is only half the equation. Staying in is where most traders blow up their accounts, and that's where we go next. A trader named David made his first trade using the 1-4 ratio framework. He did everything right. He identified a setup with two pivot confirmations. He placed his stop loss, He calculated his target. He risked $500. He targeted $2,000. The trade worked exactly as planned. Price hit his target. He closed the position. His account went from $25,000 to $27,000. He made $2,000 on a single trade. He felt alive. He felt invincible. He felt like he'd cracked the code. He'd discovered the secret that most traders never find. For the first time in his trading career, he'd made real money using a systematic approach. The euphoria was real. The confidence was intoxicating. Then came the next trade. David looked at another setup. It had the same two-pivot confirmation. It had the same mathematical edge. But this time, David did something different. He didn't risk $500 again. He risked $1,500, 3 times his normal risk. He thought to himself, I'm hot. I can size up. I've proven I can read the market. I can take bigger positions now. One win means I'm ready for bigger stakes. This is the moment where amateurs diverge from professionals. This is the moment where David's future changed. The market humbled him. The trade went against him. His $1,500 risk turned into a $4,500 loss. His account dropped from $27,000 to $23,000. He was down $4,000 in one trade after being up $2,000 on his previous trade. The euphoria inverted into panic. David chased the loss. He took another trade immediately, trying to make back the $4,500. He sized up again. He took on more risk than his account could handle emotionally. He lost again. By month 3, his account was empty. He was broke. He had the skill. He had the setup identification ability. He had the two-pivot confirmation system working. He had the 1-4 ratio framework. But he didn't have the discipline to keep his position size fixed. One win triggered emotional sizing up. One loss triggered emotional chasing. By month 3, the account was gone. This is the compounding trap. This is the pattern that destroys 95% of traders who actually understand the 1% ratio and know how to identify setups. This is where amateurs and professionals think in completely opposite ways about the word compounding. Amateurs think compounding means size up after wins. They think winning a trade gives them permission to risk more on the next trade. They think a hot streak justifies bigger positions. They think 1 or 2 winning trades means they've leveled up and should trade bigger. This logic feels intuitive. It feels like you earned it. It feels like progress. It's actually the fastest path to account destruction. Professionals think about compounding in the exact opposite way. Professionals think compounding means let the same fixed ratio work over time. They think winning one trade doesn't change anything about the next trade. They think a hot streak doesn't justify bigger positions. They think 1 or 2 winning trades is just the beginning of the math, not a signal to change the system. That's the opposite. That's discipline. That's how professionals think. Here's the math that separates these two worldviews with mathematical precision. If you risk 2% of your account per trade, and you maintain a 1-4 ratio at a 50% win rate, your account doubles every 18 trades. Let me repeat that because it's foundational. Every 18 trades. That's roughly 9 weeks at 2 trades per week. Your account literally doubles every 9 weeks if you follow the math. You don't need to size up. You don't need to chase hot streaks. You don't need to take bigger risks. The ratio does the work. The compounding is built into the math. The system is self-compounding. Let's trace this with David's numbers. David starts with $25,000. He risks 2% per trade, which is $500. Over 18 winning trades at 1, 4, he makes $2,000 per trade on average. Actually, let's be more precise. At a 50% win rate with 1, 4% ratio, 9 trades win and 9 trades lose. 9 winning trades at $2,000 each equals $18,000. 9 losing trades at $500 each equals negative $4,500. Net gain, $13,500. His account grows from $25,000 to $38,500 over 18 trades. That's not quite a doubling, but it's close. Over 36 trades at the same 50% win rate with the same 1-4% ratio, his account hits $50,000. That's a doubling. Over 50 trades, his account could hit $75,000. The math compounds on its own. The system builds wealth automatically if you don't interfere with it. David's mistake was interference. He sized up after one win. A professional would have risked $500 again on the second trade, then $500 again on the third trade, then $500 again on the fourth trade. Same ratio, same position size, no heroics, no emotional sizing, just protocol. Over 50 trades, that $500 risk at 4 would have turned his $25,000 account into approximately $50,000. No sizing up, no chasing, no emotional decisions, just the math compounding. But David wanted to accelerate. He wanted to shortcut the process. He thought one win meant he was ready for bigger stakes. One win means you're following the system, that's all. It doesn't mean you've graduated to a new level. It doesn't mean you're hot. It doesn't mean you can take bigger risks. It means the system is working. Keep executing the system. This is the fundamental psychological divergence between amateurs and professionals. The amateur sees one win and believes in himself. He thinks the win proves his skill. He thinks skill justifies bigger position. He thinks bigger positions will accelerate wealth. He's emotional. He's chasing a feeling. He's trying to prove something to himself. The professional sees one win and believes in the system. She thinks the win proves the system is working. She thinks the system doesn't require bigger positions to generate wealth. She thinks bigger positions only increase the variance and the risk of ruin. She's mathematical. She's trusting the math. She's proving something to her account, not to her ego. One emotion, one math, one trader blows up. One trader survives and compounds. Here's the counterintuitive play that separates professionals from amateurs in this critical moment. Your position size should actually shrink when volatility rises. Your risk per trade should stay fixed. If your account is $25,000 and you've decided to risk 2% per trade, that means you risk $500. That number doesn't change based on how you feel. It doesn't change based on winning streaks. It doesn't change based on market conditions. A winning streak doesn't mean you risk $1,500. A winning streak means you're confident in a system that doesn't require sizing up to compound wealth. That's the edge. That's the confidence that separates professionals. They don't need to size up to win. They let the math compound. They trust the ratio. They execute the protocol. When volatility rises, your position size actually shrinks. Here's why. If you're risking $500 per trade and volatility doubles, the distance from your entry to your stop loss expands. That means you need to buy fewer shares or contracts to maintain your $500 risk level. You're reducing position size automatically when the market gets more volatile. You're protecting your account when danger increases. Amateurs do the opposite. Amateurs see volatility and get scared. They see volatility and think they need bigger positions to compensate. They thin. Bigger positions will get them out of the hole faster. That's backwards. That's how you blow up. The professional understands that the 2% fixed risk, maintained consistently across 50 trades at 1:4 ratio with a 50% win rate, is already doing the work. The math is already generating wealth. The account is already compounding. The only thing that stops the compounding is emotional interference. The only thing that blows up the account is sizing up after wins, chasing losses, or abandoning the system when drawdowns hit. David had everything he needed. He had the skill to identify setups. He had the system. He had the math on his side. He just didn't have the discipline to keep his position size fixed. One emotional decision cost him his entire account. Now that you understand why fixed position sizing is the foundation of compounding wealth, you're ready to learn the final principle that locks everything together. Because knowing the ratio, identifying setups, and sizing correctly still isn't enough if you don't understand how professionals actually trade, which is by doing less, not more. That's where the final piece comes together. An amateur trader logs into their broker each morning with a specific question in mind. What should I trade today? That's the entire framework. That's the entire decision tree. They open the platform. They scan for movement. They look for volatility. They search for anything that looks interesting or bullish or bearish. They're hunting for trades. They're searching for action. They're looking for something, anything to do. A professional trader logs into their broker with a completely different question. Are there any setups that meet my specific criteria? 2 questions, 2 worldviews, two completely different outcomes. One leads to overtrading, burnout, and account destruction. One leads to compounding wealth and professional calm. The difference isn't intelligence. The difference is framework. The difference is philosophy. The difference is discipline. Professionals wait. This is harder than it sounds. They sit at their screens. They watch the tape. They let the market come to them instead of chasing the market. They watch price action develop. They watch structure form. They wait for the two pivots. They wait for confirmation. They wait for the 1-4 ratio to appear naturally, not force it into existence. This sounds passive. It sounds like laziness. It sounds like missing opportunities. The opposite is true. Waiting is the most active decision a professional makes every single day. Waiting is the hardest discipline in trading. Waiting is saying no to 80% of the opportunities they see, so they can say yes to the 20% with genuine 1-4 ratios and legitimate 2-pivot confirmation. The amateurs see those 80% of trades and think, I'm missing money. The professionals see those same 80% and think, I'm avoiding losses. One mindset leads to action addiction. One mindset leads to wealth. Let's ground this in real mathematics that shows exactly why trading less actually makes more money. Consider two traders. Call them Trader A and Trader B. They have the same $25,000 account. They have the same skill at reading price action. They have the same understanding of the 1-4 ratio, but they have different philosophies. About frequency, Trader A makes 10 trades per month. He's active, he's involved, he's always looking for the next setup. He averages a 1-3 ratio across his trades. For every dollar he risks, he makes $3 on average. His win rate is 60%. He wins 6 trades and loses 4 trades. His 6 winning trades at an average of $1,500 profit each equals $9,000. His 4 losing trades at an average of $500 loss each equals negative $2,000. His net profit is $7,000 per month on a $25,000 account. That's 28% monthly returns. That's exceptional by most standards. But wait, that's assuming he maintains his 60% win rate forever. That's assuming he never has a losing month. That's assuming consistency that doesn't exist in markets. Now consider Trader B. She makes 3 trades per month. She's selective. She's patient. She waits. She averages a 1-4 ratio across her trades. For every dollar she risks, she makes $4 on average. Her win rate is 55%. She wins 1 or 2 trades and loses 1 or 2 trades out of 3. Her trades are smaller individually because she waits for only the highest conviction setups. Let's say she risks $400 per trade on average. Her 2 winning trades at $1,600 profit each equals $3,200. Her 1 losing trade at $400 loss equals negative $400. Her net profit is $2,800 per month on average. That's only 11% monthly returns. That's less than Trader A. That's fewer trades. That's lower win rate. That's lower monthly percentage returns. But here's where the story changes. Trader A's win rate collapses during a difficult market. It drops from 60% to 45%. His trading becomes more stressful. The pressure to maintain frequency pushes him to take lower quality setups. He chases, he overtraders. His account volatility increases dramatically. A few bad months and his psychology breaks. He starts cutting winners early. He starts holding losers, hoping for bounces. He's no longer executing a system. He's gambling. By month 6, his account is down 40%. Trader B's 55% win rate holds steady. Actually, it improves slightly to 57% because she's only trading high-conviction setups with genuine structural confirmation. Her account volatility is lower, her stress is lower, her psychology remains clean. She enters trades with conviction because she's waited, she's confirmed, she's done the math. She holds through small noise because she knows the ratio is on her side. Over 12 months, her consistent 55% win rate at 1% ratio compounds her account significantly. Her account doubles, fewer trades, better ratios, similar monthly returns initially, but lower volatility, lower stress, lower psychology damage. Over time, the consistency of execution compounds into serious wealth. The mathematics reveal something counterintuitive. Fewer trades at better ratios with maintained discipline beats more trades at mediocre ratios with increasing pressure. Why? Because waiting forces you to be selective. Selectivity is where professionals live. Amateurs are busy. They're always doing something. They're always trading. They're always moving. Professionals are patient. They're watching. They're waiting. They're selective. Busy traders look busy. They feel busy. They think busy equals productive. Patient traders look calm. They feel calm. They think calm equals professional. Over time, busy traders burn out. Patient traders build wealth. Here's the psychological edge that separates traders who survive from traders who blow up. When you trade less, each trade carries psychological weight. You've waited for it. You've confirmed the structure. You've done the math multiple times. You've placed the stop. You've calculated the target. You enter with genuine conviction, not hope or FOMO or restlessness. You hold through the noise because you know the 1-4 ratio is mathematical. You know 2 pivots were confirmed. You know the setup is legitimate. You don't panic at small drawdowns. You don't exit early because of noise. You exit at the target or the stop. That's it. You execute the protocol. An amateur enters on a whim. She sees a stock bouncing. She feels the pull. She doesn't want to miss it. She buys without confirmation. She enters without a plan. She holds without conviction. Then the trade moves against her slightly. The noise is low. The drawdown makes her uncomfortable. She exits early. She cuts the trade at a loss or a minimal profit. She never lets the ratio work. She's gambling. She's hoping. She's afraid. She's not executing. She's reacting. A professional enters with conviction. She's waited. She's confirmed. She's done the math. She knows the 1-4 ratio is on her side statistically. She enters knowing that if this trade is wrong, she'll lose $400. She's already accepted that loss in her mind. The stop loss is placed. The exit is predetermined. The only question left is whether price hits the target first or the stop first. She can breathe. She can wait. She can hold. She can execute. This is the real hack. This is the real edge. This is how you turn 1/4 risk into 4 times reward. Not by luck. Not by being right all the time. Not by sizing up after wins. Not by trading frequently. By ratio plus confirmation plus selectivity plus patience. That's the formula. Ratio gives you mathematical edge. Confirmation gives you structural edge. Selectivity gives you psychological edge. Patience gives you compounding edge. Together, those 4 elements create professional traders. Separately, each one fails. You came into this video with a question: how do professionals turn small risks into large rewards? Now you know the complete answer. Define risk before you enter through predetermined stop losses. Identify setups with genuine 1-4 ratios where the math favors you. Confirm those setups using 2-pivot structure, not single reversals. Size fixed, not emotional, so the ratio compounds without interference. Trade less, not more, so each trade carries conviction. Wait for the market to come to you instead of chasing the market. Let the math compound over time instead of forcing acceleration through sizing up. That's the complete system. That's how professionals build wealth. That's how accounts compound from $25,000 to $50,000 to $100,000 without heroics or gambling or luck. The amateurs will continue to ask, what should I trade today? They'll continue to chase action. They'll continue to size up after wins and chase losses after defeats. They'll continue to trade frequently with mediocre ratios. They'll continue to blow up their accounts. That's their path. Your path is different now. Your path is ratio plus confirmation plus selectivity plus patience. Your path is professional. Your path is disciplined. Your path compounds. If this lesson sharpened your understanding of how to build a professional trading system, the next video on position sizing in high volatility markets will deepen that system into unshakable protocol. That's where you learn to adjust position sizes during market stress while maintaining your mathematical edge. That's where theoretical system becomes practical execution in real market conditions.